What are CEOs seeing? What is this about? And what can you tell us?
Sure. So, I mean, bottom line, Becky, is the U.S. is still strong. I think the general feeling would be that the numbers in the U.S. are holding up. The rest of the world is what's dragging down the U.S. right now. And certainly there is a fundamental mind shift, in my view, of this China-U.S. trade deal issue. A lot of people thought for the longest time we were in a tariff war. Eventually there'd be a deal. We'll get through that. You suck it up and you either take the cost yourself or you pass it on. Now people are realizing, I think, we're going to have a longer-term trade issue that's going to affect supply chains. It's going to be a much bigger issue. And that is affecting the way they're investing across the world. So these issues are topical.
And the way they're investing around the world, meaning that they are not wanting to invest in China if they're American companies, or they're not wanting to invest anywhere.
It's a great question. Actually, U.S. investment in China went up this first half of this year compared to last year. But what's happening, it's investing in China for sales in China, because that's where the market is. Where the supply chains are, they are reevaluating whether they should have supply chains move to other Asian countries or somewhere else. So it's kind of looking at both ways. They're still serving China in China, and that's still growing quite rapidly. But how they serve the rest of the world is being reconsidered.
You don't think that there's going to be a trade deal that's reached anytime soon, or other CEOs don't think that too? Well,
even if there's a deal, there's a fundamental question of whether China will be an ally or an adversary over the longer term. And you talked to, we had Bob Lighthizer at the meeting, and honestly,
at the Business Roundtable.
At the Business Roundtable meeting, sorry, and I think there really is a question as to whether we could resolve these issues that are bigger, longer term in the short term. That's why they're talking about, could we get some things off the table, de-escalate the tariffs and the war? That would help the business investment environment, and then maybe look longer term at these bigger issues.
Mark, how much of this is almost a self-fulfilling prophecy? CEOs are worried about what's going to happen with the trade talks, so they're not investing. They're worried about the economy, so they're not investing. But by not investing, that it makes it more likely that some of this economic downturn kind of washes onto our shores.
I think, actually, last time I was on, we talked about this too. I still think that's the case. I mean, there is no way that the business community sees 2 quarters of downturns in the economy, which is what you'd have for recession. We definitely see slower growth, as we talked about, but not 2 quarters of downturn back-to-back next year.
I wanted to hear your view of this and to respond. Nell Minow was on the show yesterday. Yeah. We were talking about WeWork, but then we got into a thing about the BRT. And she had a skeptical, dare I say, cynical take on the BRT statement, suggesting that if business executives believe that the economy is going to go south, or at least down, earnings are also going to go down, that by creating new metrics, was her view, creating new metrics with which to judge a company will change the way CEOs perhaps are compensated, and therefore that
it was awesome. For someone who viewed that virtue signaling, at best it's virtue signaling, at worst you can be very cynical that, oh, now they're learning, or trying to curry favor with Elizabeth Warren and Bernie Sanders by admitting you guys have been right all along. We're going to change our ways.
That argument.
That's my argument.
I know that's you.
I even went hers. I say, oh man, bring it on. That's give me another arrow in my quiver.
I asked
Was
you
this
sincerely.
you? What were you?
So here's the reality. So
did you want to do it?
Yes. So here's why, though, Joe. Listen.
Because you're retired.
This is not a change. There is absolutely recognition.
Then why do it?
Let me tell you why. Because there is a fundamental understanding of fiduciary responsibility as to long-term value creation for your company.
Yeah.
To do that, you have to focus on your strategic assets and limit risk. Your brand, your workforce, your supply chain are incredibly important to your long-term value. Today, the assets on a balance sheet of a corporation are 60% intangible. So if you get a hit to brand, if you get a boycott on your products, if you have your employees, you can't hire the best, you're going to have a risk to your long-term value.
Mark, it seemed to me that good CEOs have been doing this forever. This is just like the public
the good news is
saying to people who maybe don't follow business that closely, hey, this is what we think is important. But to me, it was like, yeah, no kidding. This is what good CEOs
great idea to impugn Milton Friedman with Elizabeth Warren as the prospective nominee of the Democrats. It's a great idea to do that. Great timing to do that.
Now
to admit she's right.
CEOs 180 plus who signed this saying, "Wow, we now have to be accountable."
A lot of people didn't.
How are we going to respond to this? What are we going to be able to say in our investor calls today?
Is it okay to try to enhance shareholder value primarily? Is that
the ultimate objective?
That's okay.
But you get there by looking for all your stakeholders.
If you don't do the other stuff, is it actually deleterious to your employees and to society in general? Joe, if you don't.
I will tell you that no CEO says, I'm going to throw my employees, my communities, my supply chains overboard for long-term value. They're absolutely hand in hand.
Let me ask you a question then. To the extent, if we believe this was already taking place, by making this explicit, how do you think this changes the dynamic? Does it?
Yes.
It does change the dynamic.
Yeah,
how
two
so
ways.
then?
Because remember, the statement on the Business Roundtable from the 1990s was only referencing shareholder and didn't talk about all these other things. So that completely changed the statement.
So therefore, the question, though, is do you think that companies are going to behave differently, and if so, how?
I think that now they have to be held accountable to a standard where they are going to be talking more about their shareholders, their other stakeholders, their communities, and so forth. I think that is to bring it to the forefront, saying this is what they're going to do. Now they have to be held accountable for it, and I think that's the next step.
Did a CYA move that the lawyers rammed down your throat?
No, the lawyers, as you would expect, are very focused on fiduciary responsibility.
I would think that the general counsel would not want it.
But this is why I say, Joe, it is clear that if you're a CEO today and you're running a large business, you are focused on all these things. And you absolutely believe that that is your responsibility. This brings it to the forefront, brings some accountability to it.
It did engender with certain, we had Binion Applebaum of the New York Times come on. It engendered the narrative that Milton Friedman has always been a false prophet. And nothing that he said. So
that's unfortunate.
You didn't know that was going to be part of the narrative?
They're not focusing on that. They're focusing on how to lead their businesses to the future.
Let me ask you this. So you still would concur that the profit incentive is a positive in that in the private sector it engenders accountability. You need to mind your P's and Q's. You need to consider consumers and how you benefit. You need to try to beat your competition by providing a better service for your employees and for customers. And those are all noble aspirations engendered by the profit incentive, right?
Yeah, the statement starts out, the principles about our first primary responsibility is to create great services and products for consumers. So it starts there. The difference is it's a long-term value creation approach whereby profit is absolutely essential. It's not quarter-to-quarter profit.
But you can't do any good things if you're bankrupt. You can't do any good things.
But this is the
if you go out of business, you can't do any philanthropy. You can't take care of your employees. You can't take care of your community. You can't satisfy customers if you go out of business.
And if you're not a good brand in your community, you don't have great employees, you cannot fulfill your obligations for long-term value creation.